Housing prices are not crashing. Let me say that again. Home prices are up across the nation, climbing by about 1% compared to last year. If you heard the housing market was collapsing, you got lied to. But here's the deal. Things are super weird right now. Home prices are at record highs and affordability is garbage. I'm going to break down exactly when mortgage interest rates will finally drop, and I will share my prediction for 2026, which is guaranteed to upset people hoping for a housing crash. This information will change how you view your next home purchase. Make sure you watch until the very end for the critical details on how the government is going to force rates lower. Right now, the housing market is moving at a snail's pace. Sales activity is at historic lows. In August, only under 500,000 homes were sold. That sounds like a lot, but 5 years ago, we were selling almost 700,000 homes in a single month. That is a massive drop. Over 30% fewer sales in just 5 years. The market is seriously sluggish. Why is this happening? 2 reasons. First, home prices are still way too high. Second, mortgage rates are still too high. If you want a 30-year fixed loan, the rate is still sitting above 6%. When rates were down at 3% or even lower a few years back, everyone bought. Now, nobody can afford it. High prices plus high rates equals a super slow market. So when will rates drop? The Federal Reserve, the Fed, recently made a tiny quarter-point cut to their main interest rate. It dropped from about 4.5% to about 4%. A quarter point. That's barely anything. The Fed has already told us their plan. They're going to cut interest rates slowly. Over the next 3 years, they plan to gradually move that rate down to around 3%. Now, for context, when mortgage rates were down at the low 3% level, the Fed's rate was basically at 0. So if the Fed only cuts rates slowly down to 3% over 3 years, don't expect mortgage rates to suddenly crash back down to 3% anytime soon. This brings up a huge piece of confusion that most people get wrong. Most people think when the Fed cuts their rate, your mortgage rate immediately drops. That is a myth. Mortgage rates don't directly follow the Fed's main rate. They actually follow what the interest rate is doing on government IOUs, specifically the 10-year government treasury notes. Think of the 10-year yield as the master switch for your mortgage rate. If the rate on the 10-year IOU goes up, your mortgage rate goes up. If it goes down, your mortgage rate goes down. Simple. Here's the proof. The Fed cut rates in 2024, but guess what? The 10-year IOU rate did nothing. In fact, it actually ticked higher. The 10-year ignored the Fed, and because of that, mortgage rates actually got worse. So just because the Fed makes a small cut does not mean the pain stops. You need to know this before you try to time the market. However, I believe the whole idea that the Fed cannot control mortgage rates is completely wrong. They absolutely can. They just don't use their main rate tool to do it. The Fed has a secret weapon. It's called the balance sheet. The Fed can start printing money and flooding the entire financial system with cash. When they do this, it's called quantitative easing, or QE. They buy up government debt. This drives the interest rates down on that debt. And since the 10-year IOU rate controls your mortgage rate, the Fed can easily crash mortgage rates if they want to. The only question is, will they? I believe the economy is going to get weaker next year. When things look bad, the Fed will be forced to step in and save the day. They cannot let the economy collapse. This rescue means they will use their heavy monetary policy tools in 2026. Get ready for very aggressive rate cuts, plus printing massive amounts of money, QE. This kind of action forces rates way lower. Could rates drop back down toward the 3% range? Absolutely. It all depends on how panicky the Fed gets. Now think about what happens when the Fed pulls off this massive rescue operation and suddenly mortgage rates drop big time. Home prices will not crash. When the Fed floods the system with cheap money, it is going to prevent any kind of housing crash. Instead, you're going to see one of 2 things. First, home prices stay flat and basically stop going down. Second, we see a sharp V-shaped recovery where prices shoot right back up. If the Fed overdoes the rescue, prices will go up even higher than they are now. This is exactly what happened during the last financial crisis and during the pandemic. Government intervention stops the crash, but it makes homes unaffordable again. If we lived in a truly free market, prices would be tanking right now. The stock market will be crashing. But our government cannot let deflation happen. The entire country would collapse under the weight of debt. So they will always step in. The good news is that most mainstream experts agree with this outcome. Looking ahead to 2026, the big housing groups predict prices will either be flat or climb up to 4%. No one expects a crash. But you have to look closer at where you live. Home prices are not the same everywhere. Nationally, prices are up about 1%. But if you're in the South, you've seen some of the biggest price drops. And if you're in parts of California, prices are taking a moderate decline. However, if you live in the North or the Northeast, home prices are still climbing higher in most areas. Where you live dictates your price reality. Right now, the market is shifting. We have fewer people wanting to buy and fewer people wanting to sell. The whole system is depressed. For years, especially around 2021 and 2022, it was a vicious seller's market. There were way more buyers than homes for sale. Prices exploded higher because demand was massive. Now, things have changed. We're in a buyer's market. There are now over a third more sellers than there are buyers. This is putting downward pressure on prices, forcing sellers to lower their expectations. This is good news if you're shopping now. But here's the final kicker. Even with more sellers than buyers, which should make prices drop, we still have a massive amount of cash floating around the economy. This is all that money the government has printed. This massive money supply naturally creates upward pressure on prices. It causes inflation in home values. So what you have right now is two forces fighting each other, sellers pushing prices down and massive amounts of extra money pushing prices up. The market is stuck. But the long-term direction is clear: higher prices. The moment the Fed gets aggressive with cheap money in 2026, those downward pressures vanish and prices launch. Keep watching the 10-year interest rate. That's the key indicator I'm watching. I will keep you updating on how the Fed's next moves will affect that rate. If you want to keep up with these massive shifts in the housing market, hit that like button. Make sure you subscribe and ring that bell so you don't miss my next video. Thanks for watching.